Start talking? Okay, good morning. This is Bart Basie. We're going to talk a little bit about personal taxes this morning. We don't have time in 15 minutes to go over everything, but I'm going to try and give you some highlights as to what's going on. If you look at the introduction that's up on the screen right now, you'll notice that the due date for personal tax returns is April 18th this year, not April 15th, as a result of April 15th falling on a weekend. So that helps us a little bit, gives us a little bit more time to prepare it. This morning, I'm going to focus a little bit on some what we call flow-through entities. These are business entities that do not pay taxes, that the information flows through to the personal income tax return. Had a major change this year with regard to these tax returns, flow-through entities. Also a little bit about Schedule A, a few itemizations if you do itemize, and some key items on retirement. Time permitting, we'll talk about Schedule C. If not, we'll do that in another program. Let's go ahead and get started with the time we have. Subchapter S tax returns are a flow-through entity. They do not pay taxes, but the owners do on their personal income tax returns. Had a change this year. You will notice in the second bullet point that the date that these tax returns were due was yesterday, March 15th. Many people are not aware of that. They said, Bart, we did not know this was of where. We thought it was due April 15th when our personal tax returns, because that's where we pay taxes. The IRS has changed that. The tax returns were due yesterday. Please contact your tax return preparer and talk to them about whether or not they filed your Subchapter S tax return. Very, very important, because there are penalties if they fail to file it. Just to let you know what the penalties are $260 per owner if the tax return was not filed and one of the schedules that's required, which is called a K-1 schedule, was not properly done. As a matter of fact, the IRS has now said if correct information is disregarded in an intentional fashion, they will charge up to $530 per owner of the Subchapter S corporation. Or if 10% of the aggregate amount of the items required to be reported were not reported, the penalty is 10%. So it's $530 as a minimum. This is important, people. Do not fail to have your Subchapter S tax return filed yesterday, even though your personal tax return is not due until April the 18th this year. Okay. Other key things to remember is what's reported on the personal tax return. You'll notice that the profits and the income shown on the Subchapter S tax return are transferred to a personal tax return. Last comment I want to make is if any of you own 2% or more of a Subchapter S, there's a special law that affects anyone who owns 2% or more of a corporation stock in a Subchapter S corporation. I had one corporation where they had over 30 owners, and it's a major problem, people, because the fringe benefits and some amounts for those fringe benefits have to flow through to the individual's personal tax return. It cannot be deducted on the Subchapter S tax return. Let's see if we can't move forward to a C corporation. A C corporation is not a flow-through entity. It pays taxes on its own, separate from the owners. The interesting thing about this, you'll notice the very first bullet point, excuse me, and that is the due date is no longer March 15th, which is two and a half months at the end of the year. Now it's the fourth month. So now we have until April 15th, or in this year, April 18th, to file a C corporation tax return, the same as individuals. It appears that the Internal Revenue Service has made a major change. Tax returns where money is required to be paid, that's personal tax returns and C corporations, are now due on April the 15th, and this year, April the 18th. And all flow-through entities, their tax returns are now due on March 15th. So the government has a month in which to input the data from the flow-through entities such as the Subchapter S corporation in order to calculate and determine whether or not the proper amounts for the individual owners are reported on their personal tax returns. As a matter of fact, if you look at the next slide, which is identified as slide number 5, it mentions limited liability company. Please be aware, those of you, and many of you have limited liability companies. A limited liability company does not have a separate tax return to file. There's a law that says check the box. Please talk to your tax return preparer to find out how they are filing taxes and paying taxes on your limited liability company. If the limited liability company only has one owner, which we do not recommend, then it's filed on your Schedule C on a personal income tax return. But if there's 2 or more owners, either a partnership, a subchapter S, or a C corporation tax return can be filed. Once filed, it must be filed every year in the same fashion. And again, like a subchapter S, a partnership tax return is a flow-through. So that any of you where your tax return preparers have filed or were in the past a partnership tax return, even if you're an LLC, limited liability company, that return was due yesterday. And again, failure to file that will result in penalties. And penalties can be up to 5% of the unpaid tax for each month that the tax return is late. So please be aware. As a matter of fact, there's a minimum penalty of $205 on that. Very, very important that tax return preparers be aware of the change in the tax law for these flow-through companies. Finally, last thing I want to mention to you is the fact of the Schedule C. Remember, I mentioned to you earlier, just briefly, if you have an LLC that has only one stockholder, or if you're not incorporated, everything shows on your personal income tax return on what is called a Schedule C, which is essentially a income statement. The one thing I want you to be aware of, though, is if any of you listening in are filing as if you're unincorporated or only have one owner LLC, I would strongly recommend you change that, and you change that so that you have a a second, we just jumped everything over here. So that you change that and incorporate. The biggest problem we have is Social Security taxes. If a Schedule C is used to file a tax return for an owner of a business, that owner is responsible for paying both the company and the employee's share of Social Security taxes on all of the profits up to the maximum amount allowed by law, plus income taxes. Recently, I was involved in an audit of an unincorporated business where the tax return preparer was not aware of this law, and the Internal Revenue Service came back with a penalty, taxes, interest, and penalties in excess of $100,000. You can imagine what the problem was. We did negotiate a settlement with the IRS, and since that time, that individual has now been incorporated and taking a $36,000 a year salary, and that's the only amount that's subject to Social Security, and making quarterly payments on estimated profits. So Schedule C is not something, excuse me, we advocate at all. Let's take a minute to look at, and I've shown a Schedule C, what it looks like on the screen here. Let's go then, if we can. Why have we gone? Bear with me just a second. Some reason, if we can't go to the right screen, we got the limited liability company, the Schedule C. Now we've got, we're going to talk a little bit about itemizing on Schedule A. What I'm going to do now is switch gears quickly to those of you who itemize your expenses. I want to give you a couple of key things with regard to this before I get into it, just in general form. If your income on the first page of your personal tax return, and you should be aware of this, is $155,650 or more, you may be penalized in itemizing your expenses because they are decreased. That's important for you to understand. Now let's take a look on the screen. I've got a little outline with regard to medical and dental expenses. Those of you who want to itemize for these, keep in mind that if you use a car to go back and forth to the doctors or the hospitals or what have you, 19 cents per mile can be deducted in addition to all your other expenses. What you should do is give your tax return preparer a list of all your medical expenses that you paid, plus insurance premiums that you paid because there's a deductible, and also calculate your use of your own personal vehicle at 19 cents a mile and total that all up. Your tax return preparer will then compare that with what is called your adjusted gross income, because the first 10% of your income that's used, for example, if you had $100,000 of income, 10% would be $10,000. And the law says that $10,000 of your medical expenses cannot be deducted. So essentially what the law says is that your medical expenses cannot be deducted unless they exceed 10%. On the other hand, there's one exception. If any of you were born before January 2nd of 1952, that's important. If any of you were born before January 2nd of 1952, only the first 7.5% of your income cannot be deducted. So those of us who were born before 1952, anything over 7.5% of our adjusted income can be deducted. If you were born subsequent to January 2nd of 1952, the first 10% of your medical expenses cannot be deducted. Let's go on to the next page and talk a little bit about state and local taxes. Okay. With regard to state and local taxes, there's a box there on 5, if you can see that up on the screen, 5A. Are you deducting income tax that you paid to the state or local government, or are you deducting general sales tax? I am a resident of Florida, and we have no state income tax, so I would check off box 5B and deduct my general sales tax that I paid personally in the state of Florida. So this is important on line 5. On line 6, obviously, if there's any real estate taxes that you paid during the year. Then you'll notice on line 7 is personal property taxes. Many states have personal property taxes. This is only if the taxes were paid on a yearly basis and were paid in the year in which you're filing that you're filing the tax return. Okay, these are the medical expenses that can be deducted for you. The next item, just briefly, I'm trying to highlight some of these, and that is your interest, home mortgage interest. If you've got a mortgage, you should have received a form from the mortgage holder of how much interest was paid on your mortgage. That amount can be deducted. Remember, you've also got line 10 that deducts it if it's on the form 1098. And if you've paid it to a person who didn't give you a form, you'd be surprised how many people contact me and say, well, Bart, I know I paid mortgage, but I never got a form telling me how much interest. Well, you can mathematically calculate that, show who you paid it to on the blank lines in line 11, and that amount can be deducted, believe it or not. Okay. Also, if you pay insurance premiums, you can for your mortgage. Okay. So please be aware that some of these items can be deducted without any problems on your income tax return. The next item are gifts to charities. So we're talking about, remember, in this whole category, there's a class of items that you can deduct if you itemize. Okay. Gifts. The biggest problem we have is that a lot of people don't realize on line 17 they should attach a form and they should get receipts. I see my wife and I donate a lot of our clothes and furniture and so forth to Habitat for Humanity and Goodwill and other organizations. And sometimes we forget to ask for a verification of the value of what we're donating, because it's important that any gift of $250 or more, you'll notice that on line 17, you should attach a form, which basically says, what are the items you gave, and do you have any receipts for that to prove it? Okay. They do allow you on line 18 to carry over something from a prior year if you did not deduct it, which is a little unusual. Normally, we don't have that type of thing. Another item that you can deduct, okay, on your tax return. Let me see if I can get the right one up there. Here it is. Okay, should be up on the screen now. And that is job expenses, unreimbursed. Please be aware of that. Unreimbursed. If you got a new job during the year, you had to travel, you had to get some education or whatever the case may be, those are deductible. You pay a tax return preparer to file your tax returns. Get a receipt. I don't care if you pay him in cash or not, pay him or her in cash or not, but get a receipt. And that amount is deductible if you paid it last year, deductible on your tax return. Safety deposit boxes. Okay. So please be aware. On the other hand, be careful. Okay, you'll notice on line 26, you've got to multiply your line 25 by 2%. The first 2% is not deductible. Very important. Finally, we've got a category called miscellaneous items. Miscellaneous items are, for example, if you had gambling losses. Now, you got to be careful. Some people may go and gamble. Technically, the law says only the amount on each individual race or whatever the case may be is deductible. But non-winning bingo, lottery, raffle tickets, okay, you can deduct them up to the amount you win. So if you lose playing bingo and you don't win anything, you can't take the deduction, all right? But if you win and you've shown somewhere else on your tax return the winnings, then the cost and what you've lost can then be deducted here. Also, you've got casualty and theft losses that can be deducted. And watch out for that. That's very sensitive because it's theft losses especially can only be deducted to the extent that the insurance that you may have does not cover your loss. Okay, the insurance proceeds are not taxable, but any losses that you've incurred over and above the insurance can be deducted on your tax return if you itemize. Okay. Let's see if we can't move on now to the next one and talk a little bit about retirement. This is very, very important. And if you want to lower your taxes for 2016 and filing your tax return, it's still not too late. Notice what I've said under the title that's on the screen. You can deduct retirement contributions that you personally make up until April the 18th, okay, of 2017 for 2016 tax returns. So I hope you don't get misled with the information I've got up here. You can actually deduct contributions that you make, repeating myself, up to April 18th of 2017 for tax return that you're filing for 2016. Okay, that's a traditional IRA that's taxed upon distribution, and a Roth IRA where there's no deduction in the current year. So you can still make contributions, but you don't get a deduction if it's a Roth IRA. You do get a deduction if it's a traditional IRA. Okay, and notice the amounts on the third bullet point I've indicated is $5,500 that you could put up. So if you haven't put that amount up, put the maximum in. And if you're 50 years or older, you can put in $6,500 to catch up. Okay, let's go to the next screen. And we're talking here about employer accounts. Now, employer accounts, again, if your employer authorizes a contribution for you on what we call a simplified employee pension plan, it's 25% up to a maximum for 2016 of $53,000. Okay, next year, or I should say 2017, that you're going to file in 2018, the maximum there is $54,000. But point I'm trying to make is you can lower your taxes that you owe for 2016 if you're involved in a simplified employee pension plan and you have not contributed the maximum that's allowable for 2016 you have until April the 18th of 2017 to make that contribution. Okay? That's important. All right. Let's go to the next one, the simple IRA accounts. This is, again, different than the previous slide. Remember, the previous slide was a simplified employee pension plan, was an employer account. This one is a simple IRA. And again, you've got until April the 18th of 2017 that your employer can help you, and you can put in $12,500. Okay? This coming year on 2017, it stays at $12,500. And then notice if you're over 50, there's a catch-up. You can put in some extra money and get it up to $15,500. And that catch-up also applies to 2016. Repeat myself and simplify it if I can. If you're over 50 years of age, and in 2016 you did not contribute up to $15,500, you have a simple IRA, talk to your employer, see if you can go ahead and put in extra, because you have until April 18th of 2017 to donate additional funds up to $15,500 and get a tax deduction on your tax return, which will lower your taxes that you owe for 2016. Okay? Now, a lot of us have 401k plans. I'm sorry to tell you that the 401k plans, the contributions end on December 31st, whatever the year is. So in 2016, you had $18,000 that could be put into it. If you were over 50 years, you had to catch up to $24,000. For the year 2017, the same amount is there. But the key point here is to understand that if you have not contributed the maximum by December 31st, you lose the right to contribute the maximum. Okay? A few minutes we've got remaining on this program. Just quickly, a Schedule C on your personal income tax return. It's not something I like to have you do. I would like to have you have a corporation or an LLC and file a different form of tax return. A couple of key things with a Schedule C. You'll notice the first bullet point says single member. You cannot have a husband and wife in a business that files a Schedule C, either the wife or the husband. I should say spouse today, and I apologize. One spouse is the only individual that can file a Schedule C. So if you have two spouses filing a joint return, and both of them are in business, you would have to file two Schedule Cs. Now, if they're in partnership, then a partnership form should be filed, not a Schedule C. And this is your personal income tax return is due April the 18th. So it's the same time as your personal tax return, because obviously Schedule C is filed on your personal tax return. I've shown you a sample of a Schedule C here. It's basically an income statement, so please be aware of that. I hope I've been of some help this morning on this brief outline of some key items with regard to personal taxes. Conclusion, you can still save some money in 2016 for you and or your clients if you're a tax return preparer watching this program with some special kind of retirement programs where you've got until April 18th of 2017 to have an individual put money into a retirement program and deduct it for 2016. And it's not too early to start planning for 2017. I like to meet clients right after we file their tax returns in 2016 for any questions and so forth, and try and make some plans for what we're going to do for the 2017. Also, be aware tax law is changing. It's in a state of flux. We expect to have major tax changes for personal income taxes before the end of this year, so we will try to keep you current on that as soon as possible. Feel free to contact me if you have any questions. You can either call me or email me. Both are up on the screen. I want to thank you very much for listening to me this morning and hope I've been of some assistance to you. Goodbye.